Okay, so today we are starting first session of our mentorship program. Mhm. So it is Wyckoffian Blueprint Mentorship Program 2026, and today's first session of batch 5. It's a free session. We hope to finish it by 11 or 11:30. We are going to learn many things. So first, uh, there is some time given to settle the room. Then I will cover who I am and why this is different. Then we'll go through the psychology, then how to shift the paradigm from structure versus setup, what should be better, what you have to follow. Then we'll decode institutional logic, what is Wyckoffian logic, and we'll have some break. Then some live chart demonstration, tool introduction, and Wyckoffian Blueprint Mentorship Program. So this is what we are going to discuss, and then if time permits, I will give uh, glimpses into how to identify swing points, what is swing low, swing high, what is intermediate term trend. That will also be discussed. It depends on how much time we spent during the question and answer, and if time permits, we'll go through it. So I'm Dr. Prashant Parate. I'm an orthopedic surgeon and I'm shoulder and knee specialist. And it's not like that I am full-time trader and I'm doing only this thing. I'm a full-time professional. I'm orthopedic surgeon and I'm working at two places. So my schedule is also busy. It's not free time every day. So I prefer positional trades, and occasionally when I get time, I take intraday trades also. And now the schedule is getting busier and busier. So I prefer systematic trading, and I have developed my indicators so that my decision making does not take much time. I just have to screen the watch list and I get 10, 12 names or 15 names, out of which I can select which one to trade into. So if I select 1000 stocks in my watch list, I can get easily 100, 200 stocks with one click which are following the trend, and then I can further screen in those stocks to get smaller list. This is why it is easier for me. It saves lot of time. Screening is very helpful because of my indicators. So basically, as I am a surgeon, uh, I do not make a cut without a protocol. Similarly, I'm a Wyckoffian trader and advise that a trade does not play without a structure. So don't place any trades without understanding what is happening, why you are taking a trade, what is logic behind that trade. So I have learned anatomy, I have learned physiology, I have learned everything about human body. Then I learned about how to perform the surgeries, when to perform the surgeries, when not to perform surgeries. Similarly, in trading, we have to understand what is the logic behind the trade setups, and then we have to take trades. Typically, what happens to the traders is there are different phases. There is a phase of excitement when a trader is introduced to trading. That person goes and takes first trade, and most of the time it is beginner's luck. First trade wins because the people who start trading, they don't start when the markets are down. They usually start when the markets are up, and the markets are making new highs and everybody is excited. So most of the time, first trade gives a win because mostly people buy. And then what happens is, because of this win, there is a overconfidence and people start adding more positions without thinking. So initially, everything is rosy, everything gives profit. And later on, because there are too many positions and markets are turning, what happens is for the first loss comes, and people feel that something is wrong, but they don't understand what is wrong, so they just keep digging into it. They try for different indicators. There is new indicator which brings new hope, but further indicators just bring more indicators means more noise and more confusion, and it leads to more losses. The problem is never the setup. The what problem is that you did not understand why the setup was forming, and is it a right time for this setup to develop? Is it a right time to take a trade in this setup? Like, people are taught to buy on dip, but when markets are clearly in uptrend from last maybe 80 candles, 20 more than 80 candles, that is not the time to buy on dip, but people are bought to buy on dip. And after nice uptrend, when they see that the prices are falling for first time, what they do is they try to buy on dip. Like in silver, prices went up to 4 lakh non-stops. From 1 lakh rupee, there was a markup phase. Prices kept on going higher and higher. And from 4 lakhs, when it came to 3 lakh 50,000, people thought now this is a time to buy on dip. It came to 3 lakh, they thought it is a time to buy on dip. So, a right time is not when markets are in trend. Right time to buy on dip is when markets are just reversing after a significant downtrend. I had clearly given instructions, or I had shared my thought process that markets have shifted upwards. Now the trend is just fresh up and it is a time to buy on dip. Few days ago we had discussed that, because most of my tool was showing that stocks are turning green in most of the indicators. My TRT was showing uptrend is beginning. My bands were showing that prices are going above the red band. Green band is appearing now. So this is the time when we have to look for buy on dip opportunities. But when prices have already gone up significantly, that is not the time to buy on dip. It is probably a time to watch out if there is a breakdown, exit, or if there is a breakout, then one can look for buying opportunities. So understanding this is very important. Why the setup forms, where it forms, and is it right time to follow that setup? So uh, why most traders fails is more important, and we have to understand that if people become dependent on indicators, then adding more indicators does not add more clarity; it adds more noise. So indicators are useful, but only when you understand the market phases, when you understand how to use the indicators correctly in that market phase. Even simple moving average crossover, 20-50 moving average crossover can be useful. But if it is not the right time, then that will fail. So we have to understand that structure of the market, how markets are created, how they are designed. If we understand that, then it will be helpful. If we use a setup without the context, then what happens is same pattern means opposite uh, thing in accumulation, and it is opposite in distribution. So there can be flag and pole pattern in accumulation, which can lead to breakout and it can lead to a new trending phase. But if it is a distribution, flag and pole will form, it will create a breakout and breakout will fail. It will trap the traders. So setup is okay, but we must understand the context behind that setup. Then many people try to predict, but what I prefer is prediction should not be the main thing. Probability should be the main thing. People give more importance to prediction that it's going to break out, it is going to make new high, or this is a target. 10%, 20% gain from here is a target. If it reaches, I will exit. They don't take probabilities. What is the meaning of probability? We have to understand that if this thing is happening, it is more likely that it will go up or it will go down. There is 70% probability that it will go up. But still 30% will be the probability that it may not work out. There will be a probabilistic mindset. Whereas in prediction, what happens? People think that now the prices are headed to a certain extent, like 20%, 25%, or 100% gain. And if that does not happen, they take it up to their ego. They get hurt. They don't exit because they don't have probabilistic mindset. So, what real traders do, who are taking trades and making profits, they have probabilistic setups. They don't go for 100% win rates. They are fine even if the success rate is 50%. I have seen many people who have just 35 to 40% success rate, but their risk reward is much higher. They can hold on to big winners. Many big investors do not have even 50% success rate, but they make very big profits because what happens is they have odds in their favor. If they are risking X amount of money, they will look for profits which is 3 times, 5 times, 10 times. Those people who are looking for multi baggers, if they buy 10 stocks or 20 stocks, most of the times 50%, 60% stocks will not go to any bagger, and 3 or 4 stocks will go to multi baggers. So there is always a probability that 30 or 40% trend following things will follow, and it will give huge returns, whereas 50 to 70% may fail and they may not give any profits. So this has to be included in your mindset so that you don't go to those set of traders who are failing consistently. Then what happens is these people who are failing, they have emotional decision making. They decide first and then look for reason. That is reverse thinking. So people get call from somebody that this is a good company, there is a good result, just buy it, and they buy it. And what happens after that is they get stuck. The prices may not go up as they expected, and then they start looking for reasons why the prices are not going up, where I failed, where are the things headed to now, what should I do. They look for confirmation from other people, they ask in multiple groups, what is the view on this stock. So all this has to be done beforehand. We don't have to take a trade, we have to understand what is happening, and when we are convinced about that trade, after a thoughtful process, only then go for that. Think like if you are buying a car or if you are buying a mobile, you will always try to understand what that mobile is offering to you, what that car is offering to you, which features you want, which features you don't want. You go to multiple showrooms and check that thing. You do research on internet, you ask your friends, and then only you make a decision to take that product. Similarly, when you are buying share, you should do this. Study that properly, study the chart, study fundamentals if you are into fundamentals. And when everything fits into the scene, only then take a decision. So this will be informed decision. It will not be a random emotional decision. So these things are very important. And then they are trading the 70%. What is this 70%? So markets trend decisively only 30% of the times. So whenever you see there is a breakout, it fails 70% times, only 30% times that is successful. And this 70% is a consolidation, it is a noise and rotation. So breakout happens, it fails, people get stuck, and big money exits at that time. And then again, when breakdown comes, other people fail, these people buy, it is consolidating. So most of the time when people are taking breakout trades, they are failing because trading ranges are 70% of the time and there is only 30% of the trending phase. So always look for a sideways price action before taking any new trade. And most traders are optimized for trend following, but they don't understand what is the real time when trend is starting. What I have done in my tools is I have added bands. When there is a bearish bias band, then I don't take a trade even if TRT color is green. So I don't buy that. When prices are above green band, then there is a higher probability that it may go into trending phase. To increase this probability, I have added PFI. When there is a very strong PFI, then prices go into trending move. When the PFI is very less, then they don't go into trending move. So I call this as a triple confluence. When trend is in my favor, when the bias is in my favor, and the forces are in my favor, then I expect that momentum will come and it will take the prices in my favor. So when all these things are aligned, then there is a better chance of having a trending move and we avoid that 70%. So out of 70%, probably I will avoid 50%, not all 70%. But still, my success rate will be much higher. So when I have noticed that the stock has gone into multi-bagger, it almost always has triple confluence in the background. And there are very few stocks which do not go into multi-bagger mode without having a triple confluence. And there are many stocks which even after having triple confluence fail to go into momentum, and that is absolutely fine, because the stocks which go into momentum, they always have that triple confluence, and there will always be some failures. So even if the failure is 40%, 30%, and success is 60 to 70%, that is always a good thing instead of trading into 70% and losing 70% times. So with this, we'll come to how to shift the paradigm from setup thinking versus a structure thinking. So what is meaning of setup thinking? People have a particular setup that I will buy on dips or I will buy on breakout, and I will just buy, I will keep on holding, or I will keep buying on dips. Even if there is a breakdown, I will just keep buying. So when there is a setup thinking, what they to think, where should I buy? They don't think about what is the current phase of market. They are not aware of structure, so they don't think about current market phase, whether it is right time to buy as per their condition, as per their setup or not. So what Wyckoffian structure can tell us is the market trending down, or is it trending up, or is it accumulating or getting distributed? So when we understand that probably this is a accumulation phase and we have to look for a setup which will give buy on dips, or a failed breakdown setup which is a kind of spring and secondary test. So that setup will give us better chance here in early accumulation phase. When it is early breakout phase, then probably a retracement entry in the buying area, or a breakout entry confirmation, that is a better structure to think about, and this is a setup which we should use at this time. So this is the difference between structured thinking and setup thinking. Then setup thinking people think which indicator works best, but there are different phases when different indicators works. So even if you check 20-50 moving average, most of the times it will have given a very big reward when the trending markets happen, and when there is sideways market, you will see a lot of stop losses. So people get confused why it is giving stop losses and when should I exactly enter in this setup. So if you understand the structure behind that setup confirmation, what is happening, where is the accumulation, what volume signatures are telling, whether the big institutes are buying in breakdown or they supporting the prices at lower level. When you understand this, then you will understand that this indicator will work only after this kind of setup has formed, this kind of structure has developed. After that, we have to look for this kind of setup. So don't use the same setup every time at all market conditions. There are different market conditions when you have to use that setup. Then next question is this a good pattern? Like flag and pole pattern, is this a good pattern? Or box breakout, is this a good pattern? So there is always a question which is, does this pattern make a sense here? It is early retracement, early uptrend, then retracement pattern makes sense. But if it is markup phase, after that first retracement is happening, that setup does not make sense there. It will either go sideways and create reaccumulation schematic, or it will break down. So either of these things may happen. Therefore, after late uptrend, retracement entry is not a good setup. So we have to think, is this a good time, or is this a pattern which makes sense at this market phase? Not is it a good pattern. Just this question does not help. Does this pattern match with the current market phase? That is the structure which we have to bring into the trading. Then people think, what will market do? What will market do? But a structured thinking person will think, what is the probable outcome from this trade? Will I get a 50% probability? Will I get a 60% probability trade? Will I have a 70% probability trade? Or is this a 30% probability trade? I'm buying it. Is it a mean reversion kind of thing? Or is it a trend following kind of thing? So what market will do is not a question. What is probable outcome? That it has fallen so much. Is it likely to give a dead cat bounce, or is it likely to give a mean reversion kind of trade, or is the market going to reverse? So this will help you understand with structure whether to take a probable trade with higher probability or lower probability. Then is there a structural reason to participate? Should be a better question. Instead of this looks like it should work. So why will it work? Just because we have taken a trade. That there is a setup and we have taken a trade. So it should work. This does not happen. If there is a structural reason to participate, then we can take that setup. So structure should always come first before any setup. And structure is confirmed, then I take a entry is justified. But setup people will think that I should enter now. This is the setup. It is confirmed setup. I will enter and I will just buy it. So how structure is confirmed? When the trend is down, like let me mark it. When the trend is down, prices are falling, then I will not buy. My structured thinking is it should go either sideways or have some uh, reversal when I know that there is higher chance of buying on dip. So there is a breakout. I know there was sideways price action. It has not given any retracement. I expect prices to fall down, give a retracement entry, and then start fresh up move again. So this is how I will use thought market cycle of Wyckoffian understanding will be used to take that trade. Okay, I will not take any trade randomly. So instead of thinking should I enter now, first we have to think, is the structure confirmed, is the entry justified, and then go for that setup. Okay, any questions, any doubts? Anyone has any questions? Okay, so there are no questions. We'll move ahead. So what should be the decision hierarchy? First, we have to think about structure, then think about trend, then phase, then setup, then entry. What does this mean? First, we have to understand what is the structure. Is it a structure of markup phase after a good accumulation schematic has developed? Like there was some accumulation and a breakout, and the phase is this. We are into markup phase when prices are expected to keep going higher and higher. So if this is a phase, I will look for breakout entry. But if we are here in the trading range, what I will look for is, has the trend changed? Is there enough evidence that enough accumulation has been done? And is it a time to buy right now? Buy on dip? Is it good? I had read a book. I don't remember the author name, but it was based on Wyckoffian structure, and he had told this that it is possible to buy here, spring and secondary test. It is possible to buy here, but he said that when prices are going up and there is a backup action, this is the best time for retailers to buy. And at that time, when I was reading it for first time, I thought, why we should not buy at this bottom when we can identify the spring, or why we should not buy at that spring and secondary test when we can identify that this is a accumulation and the spring and secondary test setup has formed. And this was early days when I was exploring Wyckoffian schematics. And we use this setup, spring and secondary test, where the stop loss is below this spring level. So this setup is used, we can buy this. But I always have said that when we buy here, the prices can go up slowly. It may not break out very significantly strongly. The up move will be sluggish, slow, and the target will always be this creek line. So what will happen when we check the TRT plus bands? The band will be bearish. Price action will be bearish. There will be a red bearish bias band, and the band will be visible like this. And most of the time, price will reach that band. It may go up, but again it fails. It comes down. So spring and secondary test will always give this as a target. But if we look for the setup which I had learned from that book, better to buy here after breakout has been confirmed. And at this time, this is a backup action. When prices start rising again, we can keep a stop loss just below this. It has a better probability of going into trending up move rapidly if the background conditions are suitable. So at this time, mostly one or two retracement entries have happened, and the breakout happens after the backup action. So breakout happens after breakout action, backup action. That is the good time for retailers to take entry, because from here we expect prices to move rapidly. So for momentum traders, this is good location, whereas for investors, this can be good location. But I do not try to buy at this bottom. That has very high chances of failure, and most of the time it remains sideways. So this way we have to understand what is the structure. Is there accumulation or reaccumulation schematic? When there is accumulation or accumulation schematic and a breakout is happening, that has better chance of success. It goes into a trending phase, it goes into breakout phase, markup phase. So context is very important. Understanding this structure is very important. After this, there is a role of trend. Is the structure trending or sideways? So when the trend is coming after sideways market, then it is very good idea to go into that. There is a enough cost built, and we have to get the result from that. So we have to understand where are we in the Wyckoffian cycle. We are going to see what is Wyckoffian cycle, what are different phases of Wyckoffian cycle, and it will take a lot of time to understand these phases, but we will see that in a while. What are these phases, how to identify that? That will be a summarized session today, and we'll discuss it in details later on. So in after everything is confirmed, structure is fine, trend is fine, the phase is right, then we have to look for a high probability pattern or setup, go to setups. Like I have retracement entry setups. If price comes into buying area, that time I'm going to buy, or if it comes into selling area, that time I'm going to sell. Even if I follow just one setup, I get good trades, I can comfortably trade. We need just one or two setups and right understanding of the market. We don't need 100 setups. If you are following 15, 20 setups, different setups, what happens is you will not be able to master anything. You will just get confused every time. So once you have a good one or two setups for different market conditions, like early uptrend, retracement entry, then market is in good markup phase, then breakout entries. I can use I start entries. I can use intermediate term trend setups for markup phase. So those two or three setups will give us very good entries, retracement entry and breakout entry. I don't like to go contrarian, so I don't use contrarian setups, but we have contrarian setups like I explained, spring and secondary test. That is a contrarian setup. Most of the times the trend will be down at that time, but still price it can be bought. So this way we can understand and then take entry precisely. So there are two ways of precise execution. One is taking entry based on our setup, like suppose I have this buying area, prices came down, went up, created a change, and this is my retracement entry setup. When price touches this buying area, I will buy. So this is one precise entry which can be taken, but I like confirmation. So what is my confirmation? Price should come down slowly. It should not fall down. So if price is coming down like this with big gap ups and big gap downs and big selling candles, what happens is it may fail down. It may close below the buying area and setup may give us bad result. What I prefer is price should come down slowly without hidden gaps. It gives entry and reverses. So if it is coming in the buying area deep in it, then I will wait for prices to go up. If it is coming down slowly, I will take entry and it will be higher probability setup for me. When prices are coming down with gap downs, I have explained this many times. So if price comes down with gap downs or big candles and it reverses, what happens is it creates a swing low. Many times price come down slowly below this swing low at least once. It does not close below it and candle closes above higher than that. So that is also a confirmation setup which I prefer. So the question is never whether this is a good setup or not. The question is always where are we in the cycle? Are we in early uptrend to take a retracement entry, or are we in markup phase where we can take a breakout entry? Okay, any questions about decision hierarchy? Please explain early phase entry again. So when trend is down, prices are falling, then it goes sideways, and for the first time it changes to uptrend. So I call this as early uptrend and I look for retracement entry mostly below 50% of this swing low to this swing high. Price comes down below 50%. I prefer buying in the buying area or at 75% retracement because that gives me at least 1 is to 3 risk reward setup. So this is early uptrend setup. Should stop loss be any fixed number like 7% or 8%? So many people use 7% or 8% as their stop loss. 8% stop loss is suggested by, I think, Canslim method, and Mark Minervini also suggests that method, 8% stop loss. But we have to understand whether the stock is for 8% kind of stop losses, or it needs 2% stop loss, or it needs 20% stop loss. It depends on time frame and the stock's moves. So suppose if a stock has a tendency to move 1%, 2%, and it goes up by 10% in one swing and comes down 5, 6%, and it has a possibility of moving up by 30, 40%, then it is okay to take a setup with 8% stop loss. But there will be some stocks which have a tendency to fall down by 20%, then they can rise by 50, 60%, fall 20%, rise 50, 60%. So in these kind of stocks, it's never a good idea to look for 8% stop losses. And there will be low beta stocks or nifty kind of thing where prices correct by 2%, 3%, they rise by 4%, 5%, and the stop loss is not 8%, and the potential is also not 20%, 30%. So if the profit potential is 100% or 200% like multi-bagger stocks people think of, then in them keeping a stop loss of 30% is also fine. So it is up to us. Stop can have a stop loss of 30% if you are expecting up move of more than 200%, 300%. But stop loss of 8% is not acceptable if you are expecting 5% up move. So that is depending on the stock. It is not universal. Please explain the entry strategy again with speed of fall, slow fall, speedy fall. When prices are in early uptrend and it is coming down with a retracement, if the fall is rapid like this, I will not buy immediately because it may continue falling, it may fail. But if there is a buying area, so this is my buying area, I want to buy here, prices went up, they fell down, it was supported and reversed. Then I think most of the time, means I have observed most of the times that price comes down below this swing low, it comes down slowly, it hits the stop loss of those people who have kept stop loss below this, and then it reverses. I have explained this multiple times in other sessions also, in Tremo course. So when price falls rapidly, I do not buy immediately. Prices go up, then it falls slowly. That is good time to look for buying opportunity when fall is slow because the forces on downside have been negotiated. So this is a buying area, prices fall rapidly. What happens? Price price is falling like this. Just a minute. So price is falling like this. This is a buying area. Price is falling like this. Either it will get supported here or it can come down below this buying area and closes up. So this is also one more setup. Yes, I will show it on the chart later on. Okay. So this is another setup which can happen. Prices fall and then they go up. So it goes below the buying area and then it reverses after rapid fall. But when the fall is slower, usually the buying area is respected nicely and prices reverse after that. So this is very important. Hetal sir, I have shown it in so many charts in past.
This is for newcomers, sir.
Yeah, so we'll see by end of the session if it is possible, we'll show.
Okay, sir.
Or else I'll share the groups chart in the groups.
Okay, thank you, sir.
Okay. Any other question? So this is decision hierarchy, the way we should think about the structure, trend, phase, setup, and entry. Okay. Then let's come to the foundation of Wyckoffian market cycle. So there are four phases: accumulation, markup, distribution, and markdown. So accumulation and distribution, they are mostly sideways phases or slow moving phases. Like prices are falling. Then what happens in this fall is institutions absorb the supply and market looks dead. What happens to retailers? They leave. So prices are in markdown. Why will institutions accumulate in markdown phases? Because they have lot of money to invest and they can invest and make the stock stop from falling. So they can buy here and prices halt. They can buy here and prices halt. They don't know whether that will be a low or not. That is very important. Therefore, they do not buy huge quantities. So if it is not working out for them, They will not keep adding. So when there are big selling days, big bad news days, and markets are falling, these big institutes start absorbing. They buy at cheaper rates, and they will buy in huge quantities. So this will turn out to be a selling climax, and it is start of accumulation. After that, what happens when the prices go up? If their absorption is complete, they will not buy. If their absorption is not complete, when prices rise, what will they do? They will sell here to bring the prices down again, because they want to buy at cheaper rate when retailers are exiting. So it may be a selling bias present here. Prices go up to that, come down again, and it may break down below this, or it may get supported, but mostly it goes below this swing low. So I have explained this in my swing point theory that when there is a one-way swing with impulse, normally prices go up and they at least once come down below this lowest close. So we see most often that when there is a downward strong selling candles and strong impulse on downside, what is impulse? We are going to discuss that during mentorship. But when strong candles are falling here, prices go up slowly. It is most likely possible that this low will be once broken again. And this creates a lower low swing low. Okay. If swing high is not crossed, prices go up. Swing high does not get crossed, prices come down, go below this swing low at least once. So this is a location where these big institutes are accumulating in the lower area. They start creating buying areas there. And what do retailers think? That the stock is in sideways phase, it is not doing anything, and it is dead. So they look for other opportunities. They forget this stock. Later on, there will be some bad news. Stock prices fall below all-time low of this trading range, but prices recover very fast and they create a secondary test. So this is how accumulation gets completed. There is a selling force, then it goes sideways, selling is absorbed. Then one more attempt of selling is tried. This is called as second point of fear. Then it goes up, creates a spring, and then prices start reversing. Markup phase comes later on. When there is good accumulation, okay, so this is small box, there is good accumulation. And what happens is later on, prices go into markup. So breakout of this trading range happens. Earlier, 2, 3 attempts of breakout failed, but gradually breakout is successful. So at that time, selling bias will disappear, buying bias will appear. This breakout will be successful and it will most often give a retracement. It can come up to the green bias band, which is acting like a support now. It comes down or it comes in the buying area and then reverses. So either it will come down to buying area to give retracement entry, or if the breakout is nicely successful, it will come down to testing of this breakout area, which is called as backup to edge of the creek setup. And then when breakout happens again, that is the right time to look for markup opportunities, momentum trades. So early trends are very good when we think in terms of bases. This is base 1, breakout happens, base 2. So once a higher base forms, this is called as reaccumulation. After second base breakout, this is a time when Mark Minervini goes for momentum trading. And this is the right time to look for faster up moves in your favor. This is a time where he advises to take 8% stop loss, and prices can go rapidly to 20%, 30%, even 100% in the stocks which are capable of doing that. It's not possible in large cap stocks. It is possible in small and mid cap stocks, especially those stocks of IPO which have come in recent years of last 1 or 2 years or 5 years, which have not gone into breakout or markup phase. So those are the stocks which are likely to go in the markup. And second base is the right time to take a trade for breakout entry and markup entries. So during accumulation, what happens is everywhere there are bad news. Prices are falling, people are afraid. Like recently, there were bad news. Trump was taking all the action. He was declaring new tariffs, and the wars happen, or many new things happen, and people are afraid of buying. They think what will happen. So after that kind of uncertain period, there will be many stocks which will start giving uptrend. They will go into fresh uptrends. So when all these things were happening, then there was most of the stocks were going down and they were in markdown phase. But later on, when the stocks turned green, I had shared the watch list that now these stocks, 300, 400 stocks have started uptrend, and it is time to look for buy on dip opportunities. So that is how accumulation works. In distribution, what happens is everything is shown as good. Prices are rising and only good news is coming. People keep telling that this is a very good stock, the results are very good, everything is fine, and it's going to work out for us. But it does not happen every time. So when there is a markup phase, prices are in uptrend, and you come to know everything good about the stock. It may be a time when distribution is just starting, because when there is a good news, there are a lot of buyers and big institutes have advantage of selling into higher prices, because these big institutes have huge amount of money, so they will not be able to sell when the prices start going down, and when they start selling, the prices either halt or they start falling down. So what happens in distribution is there is accumulation, markup phase, prices go up, create base, again markup, again base, again markup. After this kind of formation, prices go into excitement, there is a climatic up move. There are very good news, and people try to buy here on breakouts, whereas market makers or big institutes, they sell here in very good profits after buying here. So there is very huge excitement and people buy. Like HDFC Bank, there was huge excitement when there was a news of merger of both HDFC and HDFC Bank. But what happened? Prices went up rapidly. After that, it did not see same level again. So this is how distribution comes. If you know that there are very good news and the structure is like this, prices have gone up, gone up, gone up, gone up. So if this is a structure and very good news is coming, that is not the right time to buy. But if structure is this, prices have fallen, gone sideways, and there is a very good news and breakout has happened, then this may be a good time to invest. It may be possible that it can come down for retracement, create a sideways price action, but still it may be a good investment. So for investors, what I suggest is use a weekly chart, let the prices fall down, let it go sideways. After this, when the color of TRT changes to green, that is the time to buy on weekly chart for investment, not when the prices are falling. So after this, sometimes prices retrace, sometimes they don't, and they just keep going up and up. On those who are traders, I always prefer up move, retracement entry, up move, retracement entry, because mindset of traders is different, mindset of investors is different. Investors can hold on with big drawdowns and they can look for very big profits also. Traders cannot hold on to big drawdowns and they exit with smaller profits. But traders, if they try to buy on dip early on, at least once or twice, and they keep on following the trend, they have good potential of making enough profits. Okay. So at the time of distribution, there will be very good news and climatic action where people will sell. Otherwise, other thing can happen like prices are in uptrend, markup happens, it goes up, then prices start going up slowly and the falls increase. And there will be a time when it will break down. So this was markup. here the markup happens after accumulation. This is accumulation, this is markup, and this is distribution. In distribution, swing high forms, higher high forms, next high forms with shortening of the thrust. So what is shortening of the thrust will also be discussed in details later on. But shortening of the thrust is one sign that markup distribution is happening. Institutions are exiting above previous swing highs. They are looking to exit. But market still looks strong. Prices are still rising above previous swing high. So retails are buying. And ultimately there will be a markdown phase. In markdown phase, what happens? Prices fall. And what retails does? They start buying on dips. There was strong uptrend. Prices have gone from 20 rupees to maybe 200 rupees. And now retailers think that from 200 it has come to 160 rupees. There is 20% correction, I should buy, and it will go from 200 to 2000. So sometimes it happens, sometimes it doesn't. So you have to be well aware of these things, that early trend is for retracement entry, late trend is not for retracement entry. It can be a possible markdown phase. There is 20% fall. After this, if prices rise slowly, it may fall again, again rise slowly, it may fall again, and ultimately it starts breaking down. So it can spend a lot of time here, maybe 2 weeks, 3 weeks, 6 weeks, 2 months, 3 months. Prices do not move anywhere, neither they fall, neither they go up. But when they start falling again, people go in denial. I have bought here, I will keep holding. They start buying on dips, and ultimately they have very big drawdowns. So we have to understand what is accumulation, what is markup, what is distribution, what is markdown. We are going to discuss this during mentorship program in detail. Okay, any questions about this? Have you understood? Wyckoffian cycle, accumulation, markup, reaccumulation. I just said that shortening of the thrust will be explained in details, because if I try to explain all concepts, then today's session will not be finished. To understand shortening of the thrust, we first need to understand what is candle, what is swing high, what is swing low, all those things. It will take 3 or 4 sessions to understand that. We have to understand volume. After that, it will be better to understand. Okay, any other question? Okay, so we'll go with next slide. So, three laws of Wyckoff, that is the core principles. So, Wyckoff has given three laws or principles, that is law of supply and demand, law of cause and effect, and law of effort versus result. So, we need 2 sessions to explain these laws in details properly, but I will try to explain what is it. So, when buyers overwhelm sellers, then there is lot of supply, and uh, that is getting absorbed by buyers. So buyers are more. What will happen? Prices will rise. Whereas when the sellers are overwhelming buyers, they are selling, buyers are less. What will happen? Prices will fall down. So structure will show where these zones exist, from where strong selling happened, from where strong buying happened. Where is strong buying coming? Where is more demand? Where is more supply? So it will be visible on chart. Buyers having strong force will create strong buying candles. It will create a upward candle. It will have high buying PFI number. It will have a upward arrow at bottom of that candle as per my PFI indicator. So I have created to this indicator to understand where is strong buying happening, where is strong selling happening. That will be easily understood using that. Then there is a law of cause and effect. So basically, it is a simple law of physics. Without a cause, effect will not come. If you are applying force in throwing a ball, only then ball will go away. If you are not applying strong force, then ball will travel only small distance. So there has to be a cause built. And the size of price move is mostly proportional to the time spent in accumulation or distribution and the range of accumulation or distribution. When prices have fallen down significantly strongly and accumulation is happening like this with smaller structure, we do not expect this to give a rapid up move like this. It is possible that it may go up, but not in that manner. It may go up, again go into reaccumulation, again go up, again reaccumulation, again go up. So this is also another possibility. But if prices have come down like this, and then there is a trading range like this, so what is happening? Prices are getting coiled in this. This is a cause getting built. And if this cause turns out to be accumulation where a lot of people have bought is at these bottom levels, and there are very less sellers in this area, and there are very less buyers, because sellers are less, the buyers will also be less. So what will happen when the breakout happens? The cause built is nice. So there is a big cause built, and uh, this uh, big cause, like this is a big cause. So this is plotted like this, that it will make similar kind of up move. So you can think of it as a spring action also. Spring, the more the spring is compressed, more expansion can happen from that spring. So when the cause built is more, it will have more effect. Therefore, I prefer a nice trading range before taking a big up move type of move trades. Then law of effort versus result. So volume is the effort and price move is the result. When prices are falling and there are big volumes, it shows that a big effort is being applied and prices are likely to keep falling because volumes are high in selling. When prices are going up and volumes are high, then it is possible that it may have small retracement and again it may go up. So when prices are rising and volumes are high, but when prices are falling, volumes are low, it shows that the effort is on buying side, the result is produced on buying side. But when volumes are reducing on sell side, the effort is less on sell side, so result will be less on sell side. So how to identify whether the effort is buying effort or a selling effort, that will be discussed in one separate session. It takes one separate session of volume understanding, and it will make clear where the effort is bullish or effort is bearish, and that can also be used in contrarian trading, that when the prices are falling, but with this fall the volume is strong but the buying is hidden, there is hidden buying coming, we can understand whether the effort is strong but the result is not happening, then there is a effort but no result. That means there is hidden thing happening, there is a hidden divergence. Similarly, when prices go up and the volumes are very strong, but the close happens at some level which is not anticipated, then there is a hidden selling going on. So when we understand these things, then we can make better decisions whether the demand is in more control or supply is in more control, whether there is adequate cost built for the result which we are expecting. Then we can take those trades with more conviction. And effort versus result is more of a more useful when we are looking for a contrarian kind of trade. So all these principles will be discussed in two different sessions. Three laws. they require 2 sessions. Okay. Any question about laws? What I have done is I have coded these things for easy identification. Supply and demand that can be easily identified with TRT. When prices are falling down, the color will be red. It will show that supply is in force. There will be supply areas, selling zones printed like this. Prices will go up to that, react there, fall again, go up, fall again. When demand is in control, what will happen? Selling area will get broken. Only then we know that demand has started and there is a control of buyers. Then we look for buying. Prices come in the buying area. Buying areas are supported. They do not get broken. TRT will change to green and prices will give retracement entry and go up. So it has made things very easy to identify whether demand is in control or supply is in control, whether to look for buying opportunities or selling opportunities. And I can easily screen whether the stock is in green color or red color, whether it is fresh uptrend or fresh downtrend or strong uptrend or it is an uptrend or downtrend. Right. So from 1000 stocks with one click, I know which stocks are in uptrend, which stocks are in downtrend, and which stocks have turned green today, which stocks have turned red today. I can very easily get all these stock names with just one click, which takes hardly 5 minutes for 1000 stock screening. Then for cause and effect, I use my bands to understand whether there is adequate cause built or not. So when price is below the band for a long time, it can be possible that there is a strong cause built. And when prices go above that, then we know that it is a time to look for new effect to take place. And effort versus result, it is visible with my PFI numbers. So PFI is very high, prices are going up, and PFI is very high. That shows that there is a strong effort and it is producing appropriate result. So this way, all things have been coded to understand things easily. Okay, any question? Even those who have done mentorship program, they can ask question here if they want to ask any question about the tools. Hetal sir, you have any question?
Uh, you will later show how to how your screener works in this session or later on.
In this session, it will not be possible because it will take lot of time.
Okay.
But it is already recorded, so maybe I will share the link of that video.
Okay, sir.
Today we also have to look at the swing points. So it will not be a time, it will not be adequate time for showing that screener. Okay, any other questions? And so these are the principles or laws of Wyckoff. Then let us understand about the composite man. Sorry. The composite man was term coined by Wyckoff, and composite man is not a single person, but it can be an institute or multiple people with action which is in sync. So it is not possible for any one person to move the market, and it is not allowed also. But what happens is when multiple people or multiple institutes take similar action and they build their positions quietly, then This can lead to accumulation or distribution. And institutes are fighting against each other. So one institute may be accumulating and other institute may be distributing. Whichever institute is stronger will take the lead and make things happen for their favor. So probably if weaker institute is accumulating and a stronger institute is distributing and they have distributed enough, then what will happen? They will sell short. They will short and they will make the prices fall strongly. But if the stronger institute is trying to accumulate, what will happen? They will not let the prices fall. They will buy immediately. They will make the prices reverse once their accumulation is complete. So once they have bought enough quantities for their holding and a lot of supply has been absorbed from the market, whatever comes here they will absorb all that supply, and after that, as there is no supply left in the market, prices start rising even with smaller force. If you go to Jesse Livermore's book, uh, he has explained this thing, how he made things work in the favor. So first he locks all the supply from trustees or the promoters, and then he marks up the stock to up move. As there is no supply in the market, prices start going up when there are enough buyers, and they just need one advertisement. So the composite man first build the position quietly. When there is bad news, they will buy on these strong selling candles, and then market gets supported. Again, prices come down. It creates a spring. There is a second point of fear. This is first point of fear. Then there is a second point of fear. At second point of fear, again people, big institutes buy. They do not let the prices fall, and then markets halt and they start going up slowly. So they will build position quietly when the markets are not good, when the people are not willing to buy. They will build their position, but they will not uh, show you that they are buying. But when the exit is happening, it will be visible. When prices go up, there will be a strong up move, and when there is a buying frenzy, there will be very good news everywhere, and people will think this is a time to buy. At that time they will sell. They will sell in very huge quantities. There will be very high volumes. There will be ultra wide kind of bars, which ultimately changes the trend to downtrend and or sideways. So they will show everyone that there are very good news about this particular stock or commodity, and they will exit when everybody gets interested. So these composite man or big institute, they need your shares to accumulate. So they will tell you bad news and they will buy from you. But when they distribute, they need your money. So they will always show good things and the news will be very good. Like for example, if Donald Trump want to sell, what will he do? He will spread a news that I'm reducing the tariff, I'm giving it, giving this to this, or I'm declaring a stop of war, ceasefire, and everybody will get happy. They will start buying, and Trump will dump. After that, then again he will send one ship or send one bomb, and everything will come down. And when he wants to buy, what will he do? He will spread a bad news. He will tell people that I'm not signing this contract, or uh, I'm going to levy this tariff on this country or something like that. And people get panicky, they start selling immediately. And later on, what happens? We come to know that it was just a hoax. So, same thing happens. Trump is a very good manipulator. And last 2 months, there were very good moves which have given nice profits, either on upside or on downside. The IV was also high. I was trading options. So it is like that. Whenever you see a good news or bad news, it is not necessary that you have to take trade based on that news. You have to find out the structure, whether it is supporting your the news, whether it is appropriate as per your view. I don't check the news. I just check the chart. If it is giving me entry signal, I will buy. or I will sell whatever is the signal. If it is a sell signal, I will sell. If it is a buy signal, I will buy. So composite men always uh, need your shares to accumulate and your money to distribute, and they will provide the news accordingly. And it is not a conspiracy, it is a behavioral model. So if you go to Mark Minervini, what he will say, he will tell you to buy when the stock is already in uptrend and there is base on base, second base is breaking out, buy at that time. So this is good for retailers. What will what will Warren Buffett tell? He will say when there is a bloodbath on streets, buy at that time. And it is good for him because he has trillions of dollars in spare. So he can invest here, he can buy huge quantities, and he can stop that fall. Retailers cannot stop that fall. So retailers must never buy when there is a huge bloodbath like this. They get adequate opportunity. Prices go up again, it comes down slowly and falls below this swing low. So retailers will get panicky if they have bought here or here. What will happen when price goes up and comes down again? They will get panic and exit. Warren Buffett is not going to exit. He will support and make the prices go up in his favor. But he is not right always, and he also has exited the stock in losses. So it is a behavioral model. You have to decide what should be your model based on your money. If you are a retailer, it is always better to follow the trend. If you are big institute, it's better to follow what Warren Buffett says. Okay, so this this was mapped by Wyckoff in 1930s, and nowadays composite man is algorithm. So there are different algorithms running, and these algorithms can create schematics on 1 minute time frame, 3 minute, 5 minute, 15 minute, 75 minute, or even daily chart and weekly charts. So that depends on how much is the liquidity in that particular asset. So if the asset is highly liquid, like Bitcoin, like Nifty, like crude oil, then you can also see schematics on smaller time frames. But if it is illiquid, like small cap stocks, which are getting traded only 5,000, 10,000 shares in a day, then it will take a lot of time. So they will build a schematic based on daily chart or weekly chart. It will never be on 1 minute, 3 minute, because 1 minute, 3 minute will be highly illiquid. So this is very important to understand that there are people who have their ways based on behavioral model. It's not a conspiracy. Conspiracy is not allowed if it is found out that somebody is manipulating the market and he is not Trump, then he will be prosecuted. Like there was action taken on Jane Street in a few months ago, saying that they were manipulating the market or their actions were moving the markets. So there are checkpoints, but if it is being done by multiple people who are not related to each other and they are not acting based on each other information, but they are acting in sync because of behavioral model, that is allowed. Okay. So institutions cannot buy huge quantities of Nifty in a single day without moving the prices against them. If they buy a lot of quantity, what will happen? Prices will keep rising and they will not be able to buy adequate quantity. Therefore, they need to be patient, they need to be deliberate, they need to build the positions gradually, and they create conditions which make you sell to them. So they will bring the prices down, they will break down below previous swing low, and once they are favorable, they are getting high liquidity, they will buy, and then from that time they will make it to higher levels, they will take the prices to higher levels. And then they will make you sell when in the fall, and they will make you buy at high at the breakout from you. You will buy from them at breakout levels at higher levels. Okay, so this is how composite man works. So these are the four phases, which are accumulation, markup, distribution, and markdown. Accumulation is the waiting room. Prices move sideways and institutions absorb supply quietly. Retailers see this as a dead market and leaves, and smart money just keep getting started. They just are investing. They have just started. So what retailers feel in this phase is they feel boredom. They will follow some method like moving average crossover or some other method like there can be other indicators which are showing uptrend, and they will buy, but ultimately prices will come down. Again, they will try to buy, again prices will come down. 70% of the times markets go sideways, and that is the time when 70% or 60% times the setups fail, breakout setups fail, and prices keep coming down. So people get bored, they think that nothing is happening, but actually the construction is happening at that time. Then there is a markup phase. What happens in markup? Prices go breakout, come down slowly, breakout, come down slowly, breakout, come down slowly, breakout. So this is a buying on breakout mode. The prices are rising. Institutions already have their position. They have built a position in accumulation schematic. There may be some pause where they again build some position. They let the prices rise. They may hand over small amount to other institutes, and once the retail traders see the breakout, what happens? They start rushing in for markup phase with breakout entries. But often it happens when three or four swing highs have formed, not before that. And that is actually not a good time to buy on breakout. But people feel fear of missing out. Silver went from 1 lakh to 4 lakh. They want to buy after nice up move. Okay, so this is where fear of missing out is coming, and sometimes it gives very good profits in short time. But if somebody gets stuck, then it's a they get badly stuck and they are unable to exit that. And from here, distribution starts happening. So rising tide is good when it is early rise. You can look for buying on breakouts. And Minervini says when it is second base or third base, you can buy those breakouts. But once there are fourth bases and more, you should not buy these breakouts, but because there are higher chances of failure. So buy on second base breakout, third base breakout, that is fine. Buy in early accumulation, that is fine. Buy in early breakouts, that is fine. Do not buy on late breakouts, that is likely to go into distribution, which is disguised as a party. Okay, so that is their exit, and they have to tell everyone that this is a celebration. It is going to go in uptrend, it is going to new high. Already stock may have gone 10 times, and they will show that it has grown up so much and there is so much scope for the business that it is likely to keep on continuing. But the market have already discounted for future 6 months or 1 year, sometimes even more than that. And when this party is happening, retailers feel that we must also join this party. They start buying. Price is already looking strong and news is positive. Somebody will show you that this company is a small cap company with market cap of 1000 crores, and they have got 500 CR contract or 700 CR contract, or even more than their market cap. The order is more than their original market cap. You have to always be sure that it is not after 3 4 basis 5 basis of strong uptrend that these kind of good newses are coming. And even if you invest at that time, you should know that we have to exit based on predefined parameters. You must not keep on holding thinking that it is getting so many orders, so it is likely to continue the uptrend. It is possible that this order is already known to insiders, and they may be having some information that stock has already gone up so much that it is not likely to go up, and they may exit. So the exit will always be visible on the chart. And for this, I always show one example of Adani charts where there was Hindenburg report, but before that report, stock had turned red. It had closed below bearish bias band, below bullish bias band. It had already signaled exit from long positions. It had already signaled that markets are sell on rise. before Hindenburg report came. So we have to understand the markets, we have to read the market properly, see whether it is distribution happening or it is still accumulation and markup phase. So these two phases are good for investment, good for momentum trading. Distribution phase is the phase where many people get stuck, and when the fall comes or the markdown comes, they keep on buying on dip, and they keep on increasing the position which is in losses, and they keep their position in big drawdown. And when it comes to their new break even, they exit without losses, but they exit without any profit. So there is big opportunity loss. So opportunity loss is also a big loss. It is preferable not to exit, not to buy when the prices are falling and it is in downtrend. Yes, Etal sir, you want to say something?
No, sir.
Okay. So that's it about four phases. And it is better to buy when it is in waiting room or when the prices are rising, and it is better to exit when it is in distribution phase, early distribution, exit there in rapid up moves, climatic moves after nice uptrend. That is the time to exit when the party is shown for everyone. So that is the time to exit. And I sell short only when I am sure that the markdown phase has begun. So how I make sure that markdown phase has begun and I want to sell? I will look for TRT color. TRT color will be red. Candles will show red color. I will look for a selling bias. Bias band will be red. It should be thicker. So this shows that selling bias is present, and green bias is absent. So if earlier bias was bullish, it should become, it should disappear, and red band should appear. So that is the signal that markets are sell on rise or sell on breakdown. It is in markdown phase. When this happens, I do not look for buying opportunities. I will look for selling opportunities. But if there is a green bullish bias band, I will avoid selling short in this situation. Most of the time it comes to buying area or up to the bands and it reverses. So unless trend is down, TRT color is red, and prices are closing below the bands, bias bands. It can be green bias band or red bias band. So if it closes below green bias band in red color, I will exit long position. If it closes below red bias band and in red color, I will look for selling opportunities. I use this on 15-minute for option selling. So 15-minute shows bearish bias and TRT color shows red. Then that is the time where I will look for only option selling. I will not look to sell option when the prices are above green bias band. The option prices are above green bias band. I will not look to sell. Okay. So uh, Jesse Livermore Jesse Livermore says that it's never a wrong time to buy the stock which is rising. The stocks are going up, so upside is unlimited. There it can go to any level. So it's not late. If you are getting good setups, it's not late to buy those stocks which are in uptrend. It can go to any level. And falling stocks, there is no limit to fall. So it's never late to sell short. You can still make profits. If the stock has gone down by 20% or 50%, from this 50% fall, it can go to again 100% fall. So it has already fallen 50%, does not mean that it has to reverse. It can fall further, and that fall can be even 100% from that level. So fall always has a limit. It can fall down by 100%. Rise does not have a limit. If it is appropriate condition, then it can go to 100% rise or even 1000% rise. The market conditions have to be right. Okay. So have you understood everything about these four phases? Are there any questions or doubts? Yes, any questions? Do you want 5 minute break? There is only one message. Continue. Okay, fine. Just let me have 1 minute break for water. I'll come back. Just a minute. Okay, I'm back. So as I told earlier, I have built my proprietary tools, which is TRT, PFI, and smart bands. So what are these tools? TRT is tape reading tool, and it shows who is active right now, whether the trend is up or down, whether the buyers are there or sellers are there, and it also shows sideways price action. So color will be yellow or purple, or it will be black or blue. So it shows whether the price action is sideways or it is trending market. Who is more active? So if I want to follow the trend, I will buy only when the color is green. I will sell only when color is red. And this will reduce some noise when there is sideways price action. It will not have uh it will have some different color. It will not always be red or green. But it will not reduce 100% noise. It will still have some noise. It will still have some stop losses. And we have to have a view that even if the success rate is 35 to 40% for trend following, it can give big rewards. So for weekly, am I muted? Am I audible?
Yes, sir, you're audible.
Yeah. Somebody saying I'm on mute. Just let me type the message. Yeah. So he's saying that he's not able to hear. I don't know what is the problem. Okay. So the TRT, if it is green, I will buy. If it is red, I will sell. But it will not have means 100% success rate. But even with 35 to 40% success rate, I have seen that the profits are good if we follow the trend, especially for weekly charts on small caps. I have seen that it is possible that stock may have uptrend, new uptrend starts, and it keeps going higher and higher. Just to increase the success rate, what I have always said is don't buy on first green. Prices are down, it turns green for first time. Many times it comes down, fails, then second green happens and prices keep going up. And this happens because there is accumulation phase which has not been established during first green. So cause is not built. Prices are prices were coming down earlier and suddenly it changed. So sudden change is not acceptable. Prices mostly come down, change the color again, go sideways, and then it changes to green color again, give retracement entry and start up move. Why sudden change does not work out? Because institutes will not be able to get their positions with just this up move. They will not be able to accumulate adequate quantities. So if they are not able to accumulate adequate quantities, what happens? They will not support this up move. What happens? Retailers buy in FOMO and they will not be able to support. So when prices come down again, these retailers get panicked and they start selling below this area, which is a value area. So they sell below that, color changes to red. But later on, institutes start supporting it. They see that previous color had turned to green color and now it is breaking down, but breakdown is not very successful. And normally, what happens is if there is a buying area, price closes below that, and there is sell follow through selling, then downtrend continues. But if price closes below a buying area, but it reverses again and starts going up, then this is stop hunting done. Those who did not allow time for accumulation and bought before that, here they get trapped, they get exited, prices come down below, hit their stop losses, and they reverse. And this is a time where we can see contrarian people will be happy thinking that they were able to capture the bottom. But we have to allow accumulation schematic, which can be horizontal price action or it can be like this. It will go up, come down slowly. So either it will be horizontal or downward slope. We have discussed this in tops and bottom schematics. When there is a strong fall and a sideways price action, slow fall, then it is a accumulation schematic which can lead to up move. So you will notice a falling wedge or a rounding bottom pattern. So let some pattern form before buying. Don't buy when prices are in downtrend and they start moving up. V-shape recovery is successful only 20% times. So don't go for 20% odd. Look for 80% odds in your favor. Okay. So TRT will show who is right now active, whether buyers are active or sellers are active. But if we understand market structure with Wyckoffian schematics that this is not the right time for buyers to be active, then we will wait for buyers to fail and then again buyers to get activated one more time. Okay, this is why I have always told don't buy on first green, buy on second green. The purpose is let accumulation schematic form, let institutes accumulate. And if there is a uh, falling wedge kind of thing after which breakout happens and color changes to green for first time, that can give you retracement entry. Even on first time green, you will get retracement and a markup phase. So basically accumulation has happened in downward slowly falling down fashion and therefore this was successful. But if accumulation is not does not happen and there is V-shaped recovery, mostly it's likely to get failed and give you retracement entry or failure entry. What does PFI show? PFI is Prashant's force index. I have created this. It shows whether the move is genuine or not. How will it show genuine move? It will show how much is the force behind that using a numerical value. So it will suppose it is 23 for earlier buying. and selling was with 100. So this is stronger selling as compared to buying. Next time, if there is 500 buying, this is much stronger buying as compared to 100 selling. PFI of 100 versus PFI of 500. 500 PFI is much larger than 100. So it shows that this buying move is genuine and we should look for buying opportunities. So I have created 2 times PFI, 5 times PFI. I have noticed when the stocks move in nice uptrend for multiple months, they have 2 times or 5 times PFI rise in the buying move. And there is a accumulation schematic. It goes above the bias bands. And there are at least one or two high PFI buying areas. Only when breakout happens, it gives backup action. Next breakout is successful like that. So we can look for higher base formation and breakout entry, higher base formation and breakout entry. We can hold on for bullish bias when PFI is favorable in the background. So these are the stocks which are likely to go in multi-bagger mode and they are supported by a genuine move which is identified by PFI. Okay. So this is how we trade it. I have also shown how we can identify some buying opportunities using the automatic uh, trend line. There is automatic line, auto line. When a buying PFI candle closes above that, then it shows that strong buying force is happening above that line. And later on also will be able to see multiple lines above that. And there can be some one or two candles. But if it is not below this auto line, if it is not closing below this auto line, it is still time to keep on holding. So PFI has also its own setup, but it also identifies whether the move is genuine or not. And there is dynamic dual trend smart bands. So DDT SB or smart bands, we have two bands. It shows a buying bias or selling bias with green or red color, and it shows momentum. With black it is bearish momentum, with purple it is bullish momentum. This momentum or bias band colors can be changed as per your convenience, but they map the dynamic structural boundaries in real time. They show you where is the support area based on hidden gaps. So where is the support area where it is likely to hold on, and whether we should look for continuation of momentum or momentum has been lost and we can exit and take entry again later on when fresh momentum starts. So it is also very helpful. And if you take a trade based on momentum bands when bias is favorable and momentum went against you and again it starts in your favor, that can also give you opportunities for strong momentum trades. So these bias bands and momentum bands, these three have become my go-to tools always. I have a combined TRT with bands. So that is one indicator. PFI is second. I do not plot all three at a time. Either TRT plus bands or PFI. One of them at a time. That will make the chart cleaner. I can use only TRT also. I can use only bands also. Or I can only use PFI also. But not all at a time. Everything shows different things which we have explained in Tremo course also. But when we understand Wyckoffian schematics, when we understand the price action in detail, then using these tools becomes very easy. Otherwise these tools will be just another indicator which will add to confusion without giving any profits. Okay. So these are my proprietary tools, and based on these tools I have developed screeners which I have shown multiple times. These screeners will help in reducing the time. So these are time saving tools. They are not the replacement of knowledge. They are not the replacement of understanding of price action. They will not give you conviction without understanding how the prices behave. Okay. This is very important. So what is inside the mentorship program? Mentorship program teaches market reading framework. It is based on Wyckoffian schematics and phase analysis, structural trend analysis across multiple time frames, and it is a complete language of market. And the language can be learned from ABCD. Similarly, market cycles can be learned from candles, then swing points, then hidden gaps, impulses, then there is impulse, then pullback. What is impulse? What is pullback? What is SOT? What the volume is doing? There are a lot of things which help us to read the market's language. Okay, and then there are translators. So translators are, they may not always be right. Google, there is AI, and chat gpt will not always be right. So it is just used as our additional help tool to reduce the time. You have to give right instructions to that tool. You must know basics about the tool. So if you want to extract some information about a patient, and if you feed vague information, what will happen? That ChatGPT will give you very vague answer. But using your knowledge as a doctor, if you give proper inputs, that I have seen this on history, I have found out that these are clinical findings, and I'm suspecting this, and then it will give clearly different answer, and it will have much better output as compared to vague output. Similarly, if you don't understand about price action and just use any random tools, what will happen is it will not give you proper outcomes or proper returns as you expect. Therefore, I always say that I can teach you how to uh, read the market, I can teach you how to trade, but trading real time and making profits from that trading is not possible to be taught. It can be just experienced, it can be learned. I can be a catalyst who will tell you, who will reduce the learning curve, who will reduce the time frames spent in losses, because there is a structured language which can be learned. Okay, so that will be covered in the mentorship. Then there is a decision architecture. So it is 5 layer decision hierarchy. There are entry rules, risk management, then whether it is aligned to the structure or not. There is process or prediction. We should not predict, we should follow the process. So we have to follow everything, and that is how the decision architecture is developed. I always tell everyone in my mentorship that I have taught you this setup. Don't rely on it blindly. Take Go for previous charts, check the charts, study at least 100 charts. You will understand how many times it worked, how many times it did not. Then take 21 trades only on that setup. Analyze after 21 trades how many trades were profitable, how many were losses. You will build your decision architecture based on this. You will be able to understand whether you are able to follow the rules or not. And once you are able to spend time in market and have some trades, only then you will become reliably good trader. Okay, and we cover integration of tools, TRT, PFI, DDT, smart bands, and how to use them. I have some other indicators also. I have some indicator which points swing high, swing low, and intermediate swing points, which we are going to see today by end of the session in some time. And there is a method of taking entry based on intermediate swings by following a short term swing point stop losses. And when it is done along with understanding of Wyckoffian schematics, it will give small stop loss of just 1 or 2 candles, and profit potential can be huge. So we understand these tool integration, and we also review. There are weekly live sessions, there are real trade reviews, community trend, there is trend community of Wyckoffian alumni, and we discuss different charts in that. I share my watch list in those groups, and many people share their trades. So from that, there is a lifetime learning going on in the mentorship. Okay, so these sessions of mentorship, whether they are for you or not for you. So if you have ever placed a trade that looked perfect and failed anyway, and you are okay, then that is fine. This is right room for you. Because all perfect trades will not give good outcome, and all wrong looking trades will not give losses. There will be some wrong looking trades which will give profits, and there will be some good looking trades which will fail. So if you are accepting this, then it is good for you. If you are running more than 5 indicators and still feel uncertain before every trade, then these sessions can help you. You have taken a course, read a book, and yet markets still feel random to you. You can use my sessions, understand the markets better. If you are a professional like a doctor, engineer, or investor who values process over gambling, because many people just want tips. Tell me which stock to buy. They are like gamblers. They will buy 10,000 rupees, 5,000 rupees, 50,000 worth, which is not making any significant impact on their overall portfolio. And they're just taking bets. So I always prefer not to say that take this bet. I will say take this trade. This is a business. It's not a gamble. So don't go with gambling attitude. Don't play. It is a trade. It's not a game. Okay. And if you are ready to unlearn fast thinking and build structured thinking, then this can help you a lot. Because if you just want fast action, this may not work. But if you go through structured process, this will work nicely. So if you want tips, if you want calls or guaranteed returns, this is not a good place to join. Don't join my courses. Don't attend my sessions at all. If you are looking for a magic indicator, my tools are not magic indicators. They have a structure behind that. And all trades will not be successful. There will be loss making trades also. So if you want something holy grail which will give you profit all the time, don't use my tools. You are not willing to invest time in understanding the markets deeply, then don't come to these sessions, because we have 30 sessions and it will be once a week, almost 2.5 to 3 hour session every week. So if you are not willing to invest that much of time, it's not going to help you anyway. For shorter duration with indicator, it is possible. So I had developed 6 weeks to 8 weeks course, which is of shorter duration. It will not give you deep understanding, but it will give you a rule following method which can be still mastered without understanding the markets. But if you want to understand the markets, this course will give you 30 sessions which will make you almost everything clear. Okay. So market is always speaking, but are you listening? This is a very important question. What we follow is structure first. I do not teach anything based on indicators during my mentorship program. Even in first session, you will hear that I am not using indicators. So the course when it was developed at that time, there were no indicators. So the structure is completely without any indicators. How to read the price, how to read the candles, how to read the volumes, how to make trend lines. All these things were covered. Later on came a decision. So first structure, then decision whether to buy on dip, whether to buy breakout, when to exit in climax, when to keep on holding, when to follow a trailing stop loss, and then finally tools to make things simpler and to make things easier and faster. You don't have to mark anything with your hands, because what I teach needs a lot of practice, but these tools reduce that practice time. So if mastering the markets requires 10,000 hours without any indicators, these tools can bring that 10,000 hours to 100 hours. It cannot be 0 hours. You have to give that time. Okay. We are going with 30 sessions and 3 hours per session. So it will be around 90 hours. And you will have to practice on yourself. So that will give you lot of conviction by end of the course. When you take trades real time, that will build your conviction more. You have to do back testing, you have to take forward testing. So it is like retrospective study, then retrospective plus prospective study, and later on just prospective. Okay. So this is batch 5, which has started today. We are going to discuss about swing points soon, and it has a limited enrollment. We are not going to take too many people, and today is last day for to join. Who have joined live, they can still join if they have not joined the course. After today there will be no new admissions, and for more details you can go to price action with prashant.in, or you can message me in the group. Okay, any questions? Please explain PFI again. PFI is Prashant's force index. When there is strong buying force, then we can expect prices to continue going higher. When there is strong selling force, we expect prices to fall down. When buying force, suppose there is a PFI of 23. I had said it is 23, but there is a selling PFI which is 100. That means this selling candle is much stronger as compared to buying candle. Sellers are stronger here. But next time we see buying PFI of 500, which is 5 times as compared to this. That means much stronger buyers are present and we can expect prices going up. This is effort versus result principle. It shows that there is a buying effort, and with that buying effort, the prices are going up, and that is strong buying. So when there are back to back upward buying arrows, we expect prices to continue going up because just buying forces are coming. I have seen that there can be 5, 6 upward arrows back to back after that. Sometimes there can be just one downward arrow, again upward arrows. So, unless there are two arrows in one direction, I do not take it for granted that with this single downward arrow, it will change the forces to down. Unless there is a sideways price action which has made the prices go sideways and distribution has happened and selling starts here. So I use my Wyckoffian schematics. I use that understanding along with PFI. PFI will show us whether the buyers are strong or sellers are strong. There is a auto line which I can use. When close of strong candle happens below the auto line, it shows that forces are strong on sell side. When close of buying candle happens above the auto line, there is strong buying PFI above the auto line. That shows buyers are stronger and it is likely to keep on going higher and higher. Okay, that's about PFI. Any other questions? Auto line heard for the first time. So it is in the PFI. I had discussed this with my mentorship group few days ago when I had taught them that setup. We had discussed how to use auto line. Any other questions? So anyone from mentorship program wants to share their experience?
Yes, sir.
Yes, Setal sir.
After doing mentorship program, I came to know uh, composite operator, how accumulation distribution phase occurs. And initially, I was buying every dip. Now I have stopped that for long term investment. I understand the schematic and enter at appropriate time. The tool also are useful for doing FNO in my FNO stocks, and the tool are very much nicely prepared and later on improved. One thing about Prasant sir is that he is himself is a very good learner. So every time he comes up with new and new tools and give it to us every time. Thank you.
Thank you, sir. Thank you. So as you have stopped buying every dip, does it show a better result?
Yes, yes. The time value of money is what concept I learned from you.
Yes, that is very important because if we just keep buying on every dip and it stays there or keeps falling for 2 years and later on after 3 4 years it comes to break out or your break even, that means you have lost 4 years, valuable years, where even if you keep the money in FD, you will be able to make at least 7% compounding, which will be in 4 year at least 30% or more. So all buy on dips are not good. Akshay sir, you have want to say anything?
Yeah, yeah. Good morning, everybody. So, with this course, initially I was very apprehensive to join the course, but then I took the faith of leap and decided to join it. And it was really nice to learn in depth the technical analysis. Prior to this course, my knowledge about technical analysis was very superficial, and I realized that if you want to take any position in FNO, one needs to be really strong in technical analysis because it lets you know when to enter, when to exit. So, with this Wyckoffian principle, the basic understanding of the technical analysis was really, really good and made me realize when to enter, when to exit. Even for investment purpose, it is really good. And the icing on the cake was obviously the tools which he has coded because it helps you in very fast analysis of the chart. Initially, without the tools, it becomes very difficult and it was very time consuming to read the chart, one chart. But because of this TRT and band and the PFI, it really reduces the time of analysis and you can take appropriate call for your positions.
Thank you, Akshay sir.
Yeah, yeah.
Murli sir, would you like to speak anything? Murli sir is also a orthopedic surgeon and he used to take a lot of trades earlier also. Murli sir, yes, Sudhir, you want to speak? Sudhir is my batchmate. He is my very good friend.
Yes, good morning, all. Uh, Before joining this course, I had a uh, short training about trading and share market. And so I thought, why not improve my knowledge about share market, investing, and all that. So that's why I joined these courses. And it's been more than 2 years that I have been associated with Dr. Prashant. And the amount of learning is huge. And each batch, the learning is increasing, and it's a vast topic. So you need to update regularly. Earlier we used only the learning was based on the chart. Then there was different tools, PFI and DDTS. So all these tools have increased, has decreased the time of learning. But I just want to tell you one thing, or my experience is that learning is one part, but execution is other part. If you execute whatever is taught in the course, that is the most important thing. What happens is we all carry some baggage or some learning, past learning of different groups and all that. So that really influence your trading or your investing strategy. So my after experience after 2 years is that you should wholeheartedly and blindfoldly follow his strategies and not apply your modification is, is what I have experienced. That's what I want to say. Sometimes I used to take trade and then I used to wait. अरे नहीं, अभी तो कम हो गया है, नीचे आ गया है, थोड़े दिन और रुकते हैं, price ऊपर जाएगी तब we will sell, otherwise I will be in loss. So that strategy has backfired. Sometimes the share used to, the price used to drop more, 20%, 30%. So that mindset is changed now after attending this course. Yes,
Yes. Thank you, Siddhu. So
thanks.
basically, I follow the trend and I teach trend following method. And when there is a retracement, that is the time to buy in fresh uptrend. But I always tell to exit if the trend is not continued and it fails to continue in our direction. And most of the time, what happens is prices keep falling like this. They go up, again they come down in the buying area, break and continue down. So this I have noticed many times. That's why I introduced the bands, the concept of bands. And what I noticed is unless there is a buying bias band, the price continues going down. Even after change of color for one time, it will continue going down. So when we combine two things or three things, then it will go up. And that's why I had experience, that's what I have taught, that wait for accumulation schematic to develop, only then take a retracement entry trade. Don't take that before taking any trade. Before Don't buy before the structure develops. And to explain that it is easy when I am experienced, it is easy to understand when the course is going on, but it is difficult to follow practically. That's why I needed to introduce these tools. That if you are not able to follow, at least follow the tool that will clearly show you whether you are taking right action or wrong action based on a checklist. If you follow the checklist, that will give you higher chances of success. If you don't follow any checklist, then learning everything will be useless. Okay, so that was experience from our previous members. Now what I will do is I will uh, take some chart and show you formation of swing points, identification of swing points in short, because we are already at 10:47. And just a minute, let me stop sharing from this. Okay, so if I go with proper session of swing point identification, it's a 43 and 8, around 50 minutes video, which will mean that we'll have to spend time up to 1 o'clock, which will not be possible. I'll keep that for next session, but I will teach the swing point markings in short, okay, with a chart. Let me open the chart first, then I will show it. Okay, can you see this chart?
Yes, sir.
Yes. So this is a chart of Nilco. It is a daily chart. Now, normally, uh, how do we mark a swing points? When do we understand where is a swing high, swing low? So consider this as a swing low, then this, and this. Some people may mark this. Some people will mark it this way. Okay, so this is called as eyeballing. This is random marking based on eyeballing. So I have marked it this way. I can also mark it like this. It is swing low, swing high, swing low, swing high, swing low, swing high, then swing low, swing high, swing low, swing high, then swing low, swing high. So if I don't have any rules, what will happen? I will do eyeballing. I will think that this is a swing high, this is a swing low. But there should be a proper method of identification of a swing high and a swing low. Okay. What I prefer is when I want to mark swing points, I take I use bar chart like this. It shows high, low, and close HLC chart, and it is like this. I keep the color black, no other color. And then a swing low is a location, like this is the swing low. So this swing low is a location where the candle has lowest low as compared to previous few candles and next few candles. Okay. So these few candles can be two candles or one candle, or some people use 5 candle pattern. So if you use pivot point automatic calculation, then it shows 5 candle. It can also be used for 15 candle, 50 candle. More number of candles will mean that you are taking more confirmation and it's taking a lot of time to develop a swing point. So basically TRT is also based on that kind of concept where I'm using 5 candle pattern to identify a swing high or swing low, and that gives very good pattern. But if I'm plotting it manually for my swing low and intermediate swing low type of method, then what is a swing low? Swing low is a location where candle forms a low which is lower than previous candle's low and lower than previous next candle's low. So this is a 3 candle pattern. Okay, 3 candle pattern where low of the central candle is lower as compared to low of one candle before, one candle after. Whereas a swing high is a candle where high of that candle is higher than previous candle's high and next candle's high. So this is one rule. Have you understood this one rule? Low of previous candle. Just a minute.
No, sir.